Morning, everyone. Welcome back to the webinar. The last one, last one of the year, 2022. What a year it's been. To celebrate, we have a new banner. It's actually a physical banner, not a blurred one. So this is going to be an interesting conversation. I want to leave a little bit more time as at the end of the year for any questions you have for how the year has gone and what next year might bring. So please do throw those into the chat box. Thanks for joining. And we're going to talk about markets and economies and then a little bit on technology to infinity and beyond. So a good way to end the year. Let's get into the market piece first of all. And we have had a little bit of a recovery in the fourth quarter of this year. I'm glad to say. It's been a very tough year. I've been talking about equities and bonds having a tough time. The market being worried about inflation, etc., rates going up. I think we know the narrative by now. But we've had a relief rally, around about 10% or so, maybe 12%. The question is this a bear market rally, as we would call it? Or is it the end of the worst? You know, are we through the worst? I would argue for it being a bear market rally. This is a chart which shows you, I think it's in kind of brown there, the current market dynamic. We've had these bear market rallies throughout the last this year, really, as the market's gone down. And the market tends to go down and kind of recover, lurch downwards. That's generally the pattern of a bear market. And you can see that 2008, 2009, which is the last big bear market through the global financial crisis, is in the light blue there. And it's kind of mapped on each other. And you can see that we are here and we could have the next leg down. You can map these charts against each other to show most things you want, but there are fairly familiar characteristics, which suggest to me that we are in a little bit of a bear market rally, kind of a false rally at this point. And just a reminder of market psychology, which is helpful as you go through these bear markets. Towards the right there, you get that kind of public area where everyone's involved in something and you get a big bull market, which is what we've had for the last many years. Enthusiasm, there's greed, then it becomes delusion, then there's new paradigm. My word, the world is different this time. It's going to go on forever. It's a new paradigm. Then the market comes off, you get denial. It's still a new paradigm. We're okay. Then you get the return to normal. Okay, we're back to normal. This is the bear market rally. Oh, it's all okay again. We're all fine. That's a bull trap. Then you get the next leg downward. So I feel we are still in for a tough next 12 months, really through 2023, I'm afraid, is my view. That equity markets will continue to be weak as the world adjusts to a new paradigm. In fact, the new paradigm this time is high interest rates. And global liquidity is being sucked out of the market by the Federal Reserve. This shows you Fed assets on their balance sheet. In orange, those Fed assets have gone from $1 trillion on the right-hand scale there to $9 trillion. You can multiply that by 3 for the global money printing that's gone into the market, which has hit equity markets and pushed them up. So 30 trillion, 30% of GDP in world markets, 9 trillion for the Fed in the United States. You can see the S&P 500 has commensurately gone up. And that money printing is being reversed, quantitative tightening, that money is being withdrawn from the system. They've taken about $half to $750 billion out so far, and the market has come off commensurately. That tightening is going to continue. And as global liquidity gets withdrawn from the market, you tend to get weaker markets. And that's being compounded, of course, by higher interest rates at the same time. And the Fed has been, it was late. We've talked about the Fed being late for some time, but it has been quite aggressive now. It's raised rates really quite sharply. You can see its previous tightening cycles of the last 20, 30 years compared to 2022. It's gone up by 4 percentage points, give or take, in 9 months. That's a very aggressive tightening. So that's putting strains into the market already. So we're seeing some financial accidents coming through. I suspect to see more of those. We're seeing a lot of strain in the system and the economy is slowing. And people are saying inflation is kind of conquered now. Inflation has peaked in the States. It's come off a little bit off the top. You can see how it has done. This shows inflation this time around compared to inflation in the 1970s, which I've been talking about as the last kind of comparable period of an inflation shock, which was actually caused back then as well by too much Fed loosening. You can see how inflation in the 1970s in orange there Yes, it peaked, came down, and then went back up again. Now, there are oil price shocks in there as well, so it's not an exact picture, but we do have oil price strength now as well with us. And you can see how inflation kind of comes down and then increases again if the Fed doesn't get absolutely on top of it. And I suspect inflation will come back down to the kind of 4% area. Fed will pause, and then inflation will probably pick up again. That's the danger. That's the longer term danger for markets. I suspect we're going to get a similar kind of pattern. So inflation will be stickier than the market currently expects. The chance of inflation going straight back to 2% and just staying there obediently, back to 2% again, all well and good, I think that's very unlikely. For the Fed to thread the needle this time to get it back to 2% without too much pain, which is what the market's expecting, by the way, I think that's very unlikely. And all this tightening is causing, of course, a recession. I think a lot of economies are already in a recession. These are the probabilities of recession based on economists' forecasts. And you can see at the top there, as an example, the UK in red, the probability of recession in the UK now is 90%. So it's very likely we're going to get a recession in the UK or already in one. Just below in yellow is Eurozone at 80% probability. Below that is the US at 63% probability. Then New Zealand, of all places, then Japan at 30% and China at 18%. So outside of China and parts of Asia, very likely, very, very likely now we're going to get a recession. And when you get a recession, you get the next leg, which is falling profits in equity markets. So earnings come under pressure and they tend to fall. Now the market is expecting profits to rise in 2023 by about 5%. In a normal, mildish recession, profits tend to fall by about 20%. So even if we get just a modest recession, I suspect we might get a slightly nasty one, profits will fall by 20%. The market is not expecting that. It's 25% offside in terms of that particular expectation. And you can see how margins already are indicating that overall profits will fall next year. And that is something which is the next leg, which is probably get in terms of a downward leg in the equity market. And you're going to get tough times in real assets as well. This is the other thing which is going to come into 2023. So falling profits is one thing. This next thing is real asset pressure. Again, as liquidity gets withdrawn, interest rates go up. The funding costs of housing and private equity, I'll get onto that. Housing first. This is the median housing payment as a percentage of median income in the States. And you can see how it's broadly doubled, give or take, in the tightening cycle. It'll be the same in the UK, same in many Western economies. I think the UK will be worse than this in terms of people's interest rate load. And that, of course, slows everything down. And I wouldn't be long of residential housing right now in most parts of the world, because residential housing has had a bubble, as we've put in previous podcasts. And that bubble is now going to deflate, potentially quite sharply in real estate, in most places. And we're also going to see it in other real assets or private markets. So private markets which are not marked to market in the way that share prices are. So private equity or venture capital. You can see here, this is a really interesting chart if you take a moment to look at it. The blue line is the relevant one. And the blue line is the number of unicorns, so $1 billion plus valuation private companies. Private companies with a valuation of more than $1 billion, the unicorns. The number of those which were minted or declared per day through 2020, 2021, the kind of boom time. That blue chart, you can see on the right-hand axis, you're getting 1 to 1.5 unicorns per day. That was crazy. Today, that blue line is naught. So there are no unicorns being minted each day in private equity land. So that private market has collapsed in that sense. But what's interesting is the next chart. You have to decipher this one as well. The relevant line is the yellow line. And the yellow line, $2.1 trillion, is the valuation of all those unicorns together. So if you add them all up, they're valued at $2 trillion. And you can see how the yellow line has not come down yet. And yet the equity market is down 20, 30%. So the value in these private markets is still too high, and they're all going to get marked to market at the end of the year. So there's a false hope in private markets, venture capital, private equity, etc. Anything which isn't marked to market in real assets is likely to come down into 2023, and that's going to cause its own strain as people lose money in this area. And you're going to find leverage in this area which is a little bit too high, and you're going to get some financial accidents in the private markets. So note of fairly strong caution there, I think, from me. Difficult year for equities coming up again. Financial accidents very possible. Don't be long of housing, and private markets, private equity, etc. are going to have a tough time. Potential financial accidents in that area. I talked about gold as a place to hide. Central banks are buying a lot of gold. You can see this in the third quarter 2022. A lot of gold buying by central banks, and that is partly they're kind of hiding, and partly they're diversifying away from dollars. Because if you own dollars in your central bank reserves, your foreign currency reserves, and you do something really bad, like invade another country, then the US Fed is going to take those reserves away from you. So you need to buy physical gold. So a lot of central bank gold buying. Gold is a decent place to kind of hide while all this is going on. And that's going to spill over into kind of what's going to lead the market or do relatively better in this difficult market environment. I thought this was quite interesting in terms of a couple of slides to finish. These are the kind of market leaders through various phases, various decades of leadership. So what was leading the market? In the 1960s, the so-called Nifty 50, the Coca-Colas of the world, the kind of branded companies which went to very high valuations, the Nifty 50. Gold in the 1970s. There you go, good example. 1970s, era of inflation. I talked about that. Gold was the place to be to protect you from inflation. The Nikkei 225, that's the Japanese equity market in the 1980s, the glory period for Japan, when Japan was going to take over the world. That did not happen. It went into reverse. The NASDAQ boom in the 1990s, NASDAQ 100 went to the moon. That was a great tech boom and then subsequent bust. Oil prices in the 2000s and US housing in the 2000s led ultimately to the global financial crisis. And then the FANG stocks. In the latest boom, tech boom, which we've been talking about a lot, and the froth in the tech area of the market in the 2010s and into 2020. So the FANG stocks, Facebook, Apple, etc., leading the market, and that concentration on those very highly valued tech stocks, which is now, of course, deflating very substantially, as we've talked about. And lately, it's energy stocks. We're really talking about commodity stocks: gold, silver, nickel, platinum, coal, oil. Energy stocks or mining stocks, we should put on here as well, are leading the market, not upwards, but doing better than the market falling. I suspect that will probably continue. And I enjoyed this final slide, which is the new FANGs. Fuels, i.e. oil, aerospace and defense, we're living in a tougher world, agriculture, nuclear and renewables, yes, green energy. Nuclear has now been declared a green energy by the European Union. Nuclear has its long-term issues, I know, but nuclear as a green fuel, is my printer going? Nuclear as a green fuel has been declared as much. So don't be short of nuclear in your portfolio. Gold and metals and minerals on the right, that's the last FANG. So a different kind of market leadership, which I thought was interesting as you're investing within the equity market. Okay. Before there's too much doom and gloom, I came across this on Twitter. On the left, the earth is degenerating today. Bribery and corruption abound. Children no longer obey their parents. Every man wants to write a book. So do I. And it is evident that the end of the world is fast approaching. That feels like now. That was written on an Assyrian tablet from the Assyrian Empire in 2800 BC. So what is that? 5,000 years ago. So 'twas ever thus. It always feels bad. We mustn't give up hope. And you could be Qatar. I've enjoyed the World Cup, I must say, very much, outside of all the controversy. Everyone will have their opinions on that. But if you're Qatar and you've spent $220 billion to host the World Cup, which is 20 times what the other people have spent, And some people saying it's $300 billion they've spent in the last decade to host the World Cup, and all you get is grief. I'd be fairly peeved if I was in Qatar. Anyway, the World Cup's been great fun. Okay, let me give you a little relief from that, and we're going to talk about technology for a little while. And I think, so if you do have questions, pop them in the question box. Very happy to take some at the end. We've been talking about technology trends the last couple of webinars, and this is the third in the trilogy. We've been talking about quantum computing, life longevity. We've been talking about metaverse, Web 3.0, cryptocurrencies, etc. Today, we're going to talk about the kind of final kind of sleeve, robotics, 3D printing, eSports, and space technology. I'm looking at my whiteboard here to remind me what we're talking about. Space technology is going to be absolutely fascinating. And that'll kind of round out the technological themes, or certainly some of them, which we think are going to drive disruptive growth for the next decade. And I look forward to talking more about this in the new year when we have our Applied Intelligence Fund to talk about. And it'll be a really interesting time to get involved in investing in these kinds of themes into 2023 amidst the rest of the carnage, so we can get on the right side of disruption. Okay, let's start with robotics and get into the next slide. There you go. Tesla. Of course, robotics is led by our old friend Elon Musk. And this is the Tesla robot, which was unveiled a few months ago in 2022. And this is going to retail at about $20,000 US when it's launched in 2027. And it will be able to do household chores, or everything that Siri can do, answer your questions, help you out, etc. So robotics has come a long way. This thing can kind of walk and just about talk. But if you look at something like Engineered Arts, which I think is a US company, they have launched the leading humanoid robot, which is called Ameca, A-M-E-C-A. Worth Googling that and looking at the YouTube video of Ameca chatting away. Very lucid and a very convincing humanoid robot. So these are coming our way. Japan, by the way, is leading the way in robotics, but also the US. Boston Dynamics actually currently offer the most convincing robots. These are they doing a dance. Again, you can YouTube this. This is Boston Dynamics doing a dance called Do You Love Me? I'm not going to try and sing that, but it's a very amusing song. And it's a very amusing video. And these guys can dance and jump, and it's really quite extraordinary what robots can do now. So robots are going to change the world, certainly in the next decade, probably in the next few years, as these become commonplace in healthcare, in agriculture, in preparation of food, in manufacturing, obviously, and also, of course, in the military. Those are the industries really leading the way in robotics right now. And people get worried, of course, because robots are going to take over the world and they'll have AI in them, they'll be able to do anything we can do. In the same way, people were worried about agriculture back in whatever it was, the 1800s, maybe 1700s. And back in 1500, 60-70% of the workforce in America was employed or in the world rather, was employed in agriculture. So how are those jobs ever going to be replaced? Because everyone's farming, and now it's kind of almost zero, you can see in this chart. Well, of course, they were replaced by lots of other things they hadn't thought of then. Like many manufacturing jobs, many retail jobs, healthcare jobs, which weren't even invented then. And so robotics will take over the world, but they won't take over all jobs, is my view. But one area where they will be dominant is military. And outside of Ukraine, tragic situation, I think that old style war hopefully is becoming obsolete. And it'll be robotics and drones particularly who fight wars. So drone technology has exploded in the last 3 years, really led by partly the US, but also led by China and Turkey. If you look at where all these drones go, and by the way, this is a military drone. It's not like your little drone which flies and delivers your Amazon package. This is a big drone. It's like a flying, unmanned plane, basically. And if you look where these drones are manufactured, it's really predominantly China and Turkey who are supplying most nations. So China again dominant in this area militarily. So drones and robotics will come to dominate the way we fight wars. They will also disrupt, of course, supply chains and also even into space. It's unlikely we'll put humans, or less likely we'll put humans on the moon again. It's more likely to be robots who will be able to do everything a human can do. And we'll be able to take soil samples and dust samples on the moon and mine for minerals, etc. Which is a good segue into space technology, which is, I think, is a really interesting area. So the robotics is happening. It'll be disruptive, yes. It won't take all jobs away by any manner of means. It'll make life a lot easier for a lot of people. Space, meanwhile, let's go on to space technology because I think this is quite interesting. There is a race to succeed in space. So NASA in the States has stepped back. Slide fatigue here. NASA has stepped back since they went to the moon in the late 1960s and have not really done very much since. Since Elon Musk and Tesla, and it's really only SpaceX, Musk's company, which is really dominating space now. Branson and Bezos are really sideshows. So SpaceX has privatized space exploration for the US. NASA is now coming back into the fold and looking to put people on the moon in 3 or 4 years' time. But really, China and also India have stepped into the fray. So one good example is what happened just last week. The Chinese launched astronauts to go and live and work on their new International Space Station. The US launched their own space station probably 15, 20 years ago. That might be more. That ISS, International Space Station, is now being decommissioned by America. It's going to be dismantled by 2025. China's just launched its own. The US banned China from its ISS, and China said, okay, I'll just build our own. They spent $80 billion building it. It's now ready. Astronauts flew up last week. And the International Space Station is... there they go. And there they are on the International Space Station. Well, it's the Chinese space station, I should say, really. But here's what it looks like, and it is an extraordinarily powerful and important piece of equipment to have in the skies. And this is actually it, because it's a staging post to the moon and asteroid mining, which I'll come back to in a minute, which is the real prize. Dominance in space gives you dominance also militarily in terms of satellite technology and military missile technology, and also the brave new world in terms of mining in space, mining asteroids. That is really the story here. And let me get onto that in 1 second before I bring you up to date with what's been going on. The future. The future is building space hotels and space communities in space. And China is, I think, looking to open its first space hotel in 2027, 2028, quite remarkably. This is a vision of the future of what they could look like. And moon base in the meantime, a nuclear-powered moon base by 2028. The moon is terribly important for this whole story because the gravitational pull of the Earth is so great, 22 times the norm in the solar system. To base yourself on the moon, to be able to go off to other planets like Mars from the moon, is incredibly important. So China have landed on the moon many times since America went there. They landed on the dark side of the moon 2 years ago, which was deemed to be impossible, and they did it. And they will be actively mining there shortly for minerals. And they're also on Mars. The US also went to Mars. This is the Chinese Mars rover, which has been there for some considerable time. And Mars is the next great destination for human colonization. I'm jumping around a bit. Military, I've talked about the hypersonic glide vehicle, which is a Chinese vehicle, which no one's seen. I've talked about it a lot. It's able to fly around the world and deposit nuclear weapons wherever it wishes to. The technology is beyond the US, and those missiles can fly below radar and over the South Pole, not the North Pole, which is not defended by the US. So China, through its space technology in this hypersonic glide vehicle, has achieved military superiority in space and the upper atmosphere. And the Indians are going too. This is the Indian rocket. They're planning to go to the moon and to Mars. And this is what it's all about, minerals. A couple of slides of minerals, then I'm going to explain what this really is about. This is rare earth production. Rare earths are those minerals which are required across pretty much all technologies of today, mobile phones, electric cars, etc. China dominates production of rare earths. And the US imports 80% of its rare earths from China. This is a big geopolitical problem. It hasn't been weaponized yet, but China will weaponize this at some point. And America has to get its rare earth production in order. America used to be actually the dominant rare earth miner back in the 1980s, early 1990s. You can see that Mountain Pass, which is the Californian rare earth plant in America, dominated production. Look how that's declined. Look how China's become dominant in rare earth oxides. Big problem for America. And how do you solve that? Well, you solve it actually by producing your own and also by going to space. It is quite extraordinary. If you think about, this is a story about minerals and space. If you think about the Earth, 4 billion years ago, turns out, was a molten rock made up of molten metals, like rare earths, like nickel, like copper, like cobalt, like iron. When the Earth cooled, all those heavy minerals and rare earths collapsed into the Earth's core. So there aren't many left on the surface anymore. We kind of mine for these things, but there aren't many left. If you go to the core of the Earth, it turns out, let me get this right, the core of the Earth contains 1.6 quadrillion tons of gold. That's where all the gold went. 1.6 quadrillion tons, enough to coat the Earth's surface to 0.5 meter. That's how much gold there is in the Earth. We can't get to it because it's the core. Asteroids were formed at a similar age 4 billion years ago, and they're left over from the formation of the solar system. They're flying around, and they're full of all these heavy metals and rare earths. So iron, nickel, cobalt, lithium, copper, gold, palladium, platinum, silver. Asteroids are packed full of them. And one asteroid contains enough of those minerals to last the Earth for tens of millions of years. One asteroid. There's one called 99942 Apophis, which is coming near to the Earth in 2029. Got to be careful not to let it bump into the Earth. But if we can mine that thing, or even better, capture it, they talk about capturing these asteroids, rotating with them, slowing them down, taking them off their path and pulling them off to the moon, and then mining them. Much safer thing to do. Take the asteroid, put it onto the moon, start mining it. Our rare earth issue would be over. Sounds a bit science fiction, I know, but everything does until it happens. That's the real goal. Asteroid mining. There's also on the moon many of these rare earths and gold and silver and platinum and palladium, as well as water, by the way. So mining on the moon is a big deal as well. So this is a proper geopolitical race in space technology. That's the point I want to get across. Cool. Let's talk about 3D printing. We've got 10 minutes left. I'll be fairly quick on the 3D printing. Intriguing thing. You can now buy 3D printers for your desktop. You can make anything you like out of plastics or metals or wood for that matter, or food, it turns out, whatever you want to put into your ink cartridge. You take plastic filaments. These are there. You pop them into your 3D printer and the 3D printer prints whatever you like. Shoes, this complicated object, prosthetic limbs. So if these can be printed in your home or nearby, your supply chain collapses. So this is as disruptive as it gets in terms of the way we've configured manufacturing globally. So 3D printing is revolutionizing manufacturing as we speak. And it is happening now. Oh, by the way, food. 3D printed burger and fries, that can be done now. That's coming your way soon. You'll go to your Burger King and it'll be 3D printed for you. No delivery, no storage, no, yeah, they transform that. You get that. So 3D printing is as disruptive as it comes, kind of below the radar. But look at what GE are doing. They've just made they're the largest 3D printer in the aerospace industry, which is the size of most people's homes. And they're 3D printing parts for aircraft engines, GE aircraft engines. This is the facility. This is the engine. So it's not completely 3D printed, but many of the parts in that are, and many of the parts in a new Boeing aircraft are also now 3D printed. So this is 3D printing using metal technology at scale. Again, transforming, and no one's really talking about this, but you want to be invested in 3D printing, which we will be as part of the AI fund, of course. So quite quick on 3D printing. I was quick on it, but it's probably the most disruptive thing we're talking about. The final one is a little bit of a fun one. And then, of course, very happy to take questions for 5 or so minutes. Esports, another area we're investing in for the fund. How do you define esports? So first of all, esports are massive. Okay, now this is not gaming where you sit at home playing Fortnite and things. The gaming is huge. Okay, I was reading that the top gaming revenues, Pokemon is taking $90 billion. Call of Duty is taking $20 billion. That's you playing at home. Esports is all tournament based. It has to be people competing with each other for prizes. That's esports. Esports today has 500 million active viewers globally. 500 million. For context, the National Football League, American football in the States, has 60 million. Basketball in the States has 60 million. F1, probably a billion actually. Olympics, 2 billion. World Cup, probably 3 billion. 500 million watch esports actively, either online through YouTube or Twitch tournaments. Twitch is another channel for esports, it turns out, or physically in stadiums like these. Look at this thing. That's a stadium. They watch people play games. I know. It's kind of weird, but it's happening. So esports has become massive. In terms of the revenue generation, it's mostly sponsorship of these players, partly media rights and partly ticket sales. In the Fortnite, which is a great online game, I'm told, the Fortnite World Cup final, the winner of that tournament took home a prize of $3 million US. That's more than winning the US Open in golf, or in tennis for that matter. $3 million prize for winning the Fortnite World Cup final. They're giving away about $250 million per year in prize money in these tournaments. And the most popular are Counter-Strike, League of Legends, and Fortnite. And Korea is the leading market. Fascinating area. If you'd like to get involved and win these prizes, the pros train between 8 and 12 hours a day, every day. It's a full-time occupation. Amazing area, which again is happening and not many people talk about it, and it is coming to a school near you. There's actually a school in Sandton, can you believe it, in Johannesburg, South Africa. And they're going the eSport way. So people get to learn through gamification in fancy chairs with computers in front of each other and compete with each other, and they get educated that way through an eSports environment. So eSports is becoming, is a big thing and growing by around 20% per annum. Great thing to invest in. Okay, I'm going to take some questions, then sum up. Let me see. Jack de Villiers. Hello, Jack. Are balanced funds and active managers amending their positions to benefit or hedge from the new FANG's upside? Okay, interesting question. I think the technology bust is almost over, but not yet recovering. I'd say the FANGs, I can't classify the FANGs as one narrative because, well, if you include Tesla in there, I mean, Apple is completely different to Tesla. Facebook or Meta is completely different to Alphabet. And Netflix is very different to any of them. So it's a very different kind of, it's become a collective just because they become the biggest. Are they close to their bottom? Very potentially, yes. And I think people are looking to bottom fish there. I think the interesting area is the one we're talking about, which is the disruptive smaller companies in these very disruptive areas. And that's what we're looking to invest in the Applied Intelligence Fund, the AI fund. We'll talk about that next year. We'd love to invest in that alongside you, because I think by next year, if we get the market shakeout, these things will be kind of, dare I say, bargain basement type of valuations, which I think would be really interesting. Okay, Johan asks, what hikes in interest rates for 2023 do you expect? Okay, so I think we're probably close to the top of hikes in interest rates. I mean, you're going to get another probably 1% on top. The Fed funds rate will get to 5-ish. Maybe 5.5, 6 could happen. But a lot of the heavy lifting's probably been done there, but it hasn't conquered inflation yet. So what you're going to get is a few more rate hikes, but not that many, but it's going to be held at that level for longer because inflation is going to be too sticky coming down. So the Fed chairman said it. Rates can be a touch higher than people think, but for longer than people think. But the market's not listening to him. It really is quite extraordinary to me. Maybe people haven't been around long enough to remember the 1970s and how sticky inflation can be, because we haven't had inflation for 40 years. And people think the Fed will just going to solve it. And I don't think they will in the near term. How about healthcare stocks going forward? I think healthcare stocks are very interesting as a subset of the market, particularly in gene editing and biotechnology we talked about, I think, last week or last time. Again, in that disruptive healthcare area of biotechnology. Biotechnology stocks are completely bombed out. It's a really interesting time to be getting involved in them. Next question, maybe the last question, I think. Barry, Matthew, your bear market slide, your slide on bear markets. Are you suggesting exiting the market for 6 to 8 months to avoid the big drop? Listen, I think timing these things is very difficult. I'm more out of the market than in, but if I was still in the market, it's very difficult to time the next drop. I think we will get another drop. Backup disclaimer. For clients generally, a balanced fund, I repeat, is always the right option. And we will make those timing decisions for you in the background. So a mix of equities, bonds, and other, always the right solution, because you're talking about 10 years, not 1 year. If you want to be cute, it's not a bad time to sell some stuff and wait on the sidelines. But you've got to be very cute on that and don't miss the bottom. So leave it to the professionals in the background, and balanced fund is the way to go. Any news on the AI fund possibility? Yes, we'll definitely be talking about that next year as an active investment opportunity. Again, we're trying to time it. So we'll catch, hopefully, towards the bottom of the market in these tech stocks. And I think that'll be a really interesting, can I call it co-investment opportunity? I'll definitely be investing in that. I would think in the first half of next year. So we'll definitely be in touch on that. I think it's a really exciting thing. And then finally, I think, is this a good time to sell your property? I'm just going to say yes to that, wherever you live. And US CPI, you know, data predictions for the 13th. I don't have data predictions for the 13th of this month for US CPI. I suspect it will keep on coming off, and I suspect the market will kind of like that for a little bit longer. But I've been wrong on that before. I mean, it could surprise on the upside. I think that's very, very difficult to call near term. I'm not in the business of 2-week predictions. But thank you for the question. Can I thank you for the interest in the questions all year long? I've actually really enjoyed it. It's been a very tough year. I hope you're in good shape and enjoy a very much well-deserved break over the December period. And I look forward to seeing you again in January. Take care.